trading family, grab your helmets and tighten your stops. Because at 5:15 p.m. Eastern today, CENTCOM confirmed active strikes on Iranian soil, and the cash market wasn't even open to react. That's the Thursday morning gap we're walking into blind.
Quick note before we go any further, nothing we say here is financial advice. We're two guys breaking down markets, not telling you what to buy or sell. Do your own homework, manage your own risk.
Futures are ugly. S&P futures down about 20 handles from the close, NASDAQ futures bleeding, the VIX perched at 20.59. Crude is the headline. West Texas Intermediate crude down to $88.90 overnight. Brent holding near 92. The tension today is simple. The market priced Trump's Wednesday morning threat with yesterday's sell-off, but it hasn't priced actual kinetic exchange. That's the fresh tape.
Right, and the S&P closed below the 50-day moving average for the first time since March. Volume was heavy, and the 10-year yield spiked to 4.52%, a move that screams repricing, not noise. The VIX at 20.59 is signaling the kind of uncertainty where my wave trader algo is completely blocked on rate of change. Anything above 5.3 triggers a freeze. So I'm watching from the sidelines, no new entries.
And I'm staring at my TFT algo's tech positions getting absolutely clapped. Simi's got drill team 6 yesterday, and I'm not buying the dip, not yet. I'm just breathing and watching.
Let's get into the two stories that matter most today: the Iran escalation and what the CPI internals actually told us. WC, take the geo front.
So, everyone lived through yesterday's sell-off based on Trump threatening to blast Iran back to the Stone Age. That was a headline, a threat, a tweet-level event. What nobody saw coming until after the bell was CENTCOM, issuing a statement at 5:15 p.m. confirming actual strikes on Iranian soil. Then, overnight, Iran retaliates. Not a proxy thing, direct missiles into Bahrain where the Fifth Fleet is stationed, Jordan reporting 20 missiles in its airspace. Kuwait shutting its airspace. Ships are going dark through the Strait of Hormuz, transponders off. That's not a tweet war. That's a response loop with its own momentum.
And the crude market is pricing it. But weirdly, West Texas Intermediate crude at 89, Brent at 92. Those numbers are elevated but not panicked. The market remembers the April 8th template. Back then, Trump paused for 2 weeks, and oil dropped 9% in a single session. So now, every trader is looking at this escalation and thinking, what if they pause again in 4 days? That skepticism is baked into the energy equity reaction.
Exactly. The energy sector, ETF. Energy sector is only up 2% this week, despite crude above the 88 handle and the Strait effectively closed. That math doesn't compute unless the market is pricing a ceasefire within 2 weeks. My gut call account is long the energy sector, ETF. And I'm watching this gap like a hawk. If that 88 handle holds and crude doesn't fade, the energy sector ETF catches real institutional money by midday. If crude slips below 88, then the April ceasefire template is the right map, and I'm holding a position that's fighting the tape. I'm not adding, I'm just watching.
And this connects directly to the CPI story that everyone misunderstood yesterday. The headline print was 3.8%, above the 3.6% consensus, but still elevated on the surface. But the core CPI, which strips out food and energy, came in at 3.5%, roughly in line with expectations. That's not a wage price spiral. That's a gasoline station inflation story. 60% of the headline move came from an 8.2% month-over-month surge in gasoline. That's a supply shock driven by this exact geopolitical tension, not by overheating demand. The bond market spiking to 4.52% on the 10-year was a knee-jerk reaction to the big, scary headline number, not a careful read of the composition.
So you're saying the bond market overreacted to a gasoline story?
That's exactly the thesis. The shelter component is still running at 0.4% month-over-month. That's the sticky part the Fed actually watches. But the headline panic overshadowed everything. If tomorrow's PPI data doesn't show pass-through from higher energy into core producer prices, that yield spike reverses hard, and tech gets a relief bid. But if PPI confirms that the HBM memory chip inflation is bleeding into the numbers, then the bond market was right, and the sell-off has legs. That's the tension.
And that brings us to the hidden story. Nobody's talking about enough. Bloomberg reported HBM memory chip prices up 40% quarter over quarter. We're talking HBM3, the high bandwidth memory that goes into every artificial intelligence accelerator. Executives are calling the price surge insane. That's structural. That's not a one-off gasoline spike. That feeds directly into tomorrow's PPI and into the cost structure of every hyperscaler buying NVIDIA chips. So you've got consumers squeezed on energy, and now cloud margins getting squeezed on memory prices. That's the stagflation puzzle.
I've been tracking this. The HBM3 supply is tight because Samsung and SK Hynix can't bring up yields fast enough while Micron is racing to catch up. This is demand pull from artificial intelligence infrastructure building that creates its own inflationary cycle. The bear case is that this flows into producer prices tomorrow. Core PPI consensus is 5.4%. And if it comes in above that due to memory costs, the stickier inflation narrative gets a pillar that the Fed cannot ignore. The bull case, if you want to call it that, is that Micron's pricing power gets monstrous, and the semis catch a flight to safety bid even if macro stinks. My gut book is flat, just watching Micron to see if the thesis holds.
My TFT algo is already long semis, so the HBM story is a double-edged sword for my system. On one hand, if memory prices run, Micron and the semis basket could rip. On the other hand, the same story squeezes the hyperscalers and software names that my algo also holds. So I'm not celebrating, I'm not adding, I'm just sweating.
Adobe reports tonight, and that's the perfect test. Estimate is $4.74 per share. If Adobe guides margins lower because of cloud infrastructure costs or memory-related expenses, that HBM squeeze becomes real for the whole software complex. If they beat and guide up, tech gets a bid regardless of macro noise.
Quick earnings preview then. Beyond Adobe, the calendar is quiet this week. No other heavy hitters. But Adobe matters because it's the first big software name since the HBM news broke. After the bell, that's the appetizer before tomorrow's main course of PPI and the ECB.
Speaking of which, the economic calendar tomorrow is loaded. We get the producer price index, headline PPI consensus at 6.4%, core at 5.4%. Both month-over-month components expected to decelerate sharply from prior readings of 1.4% and 1.0% respectively. If that deceleration materializes and core stays calm, the bond market was wrong, and we get a relief rally. But if the HBM memory price surge and energy pass-through push core higher, that validates the 10 years move and hits risk assets again. The ECB rate decision also drops tomorrow. Consensus expects a hike to 2.4%. Up from 2.15%. That makes the Fed look even more behind the curve and puts further upward pressure on the dollar. Christine Lagarde speaks after, so any hawkish nuance could rattle European equities and spill over.
And next week, the calendar gets interesting with China retail sales and the Bank of Japan rate decision. But that's not our focus today. The only thing that matters right now is whether PPI confirms or denies the CPI story.
Let's talk sector rotation. Because the one-week performance board is a shocker. Technology, ticker XLK, down 10.89% in a single week. That's a crash. Consumer discretionary, XLY, down 3.49%. Meanwhile, consumer staples, XLP, up 4.47%, healthcare, XLV, up 4.41%, and real estate, XLRE, up 3.45%. That's a quality bid, not a pure defensive panic.
The market is being selective, and that's actually a healthier signal than people realize. XLV has earnings visibility. XLP has pricing power. They're not hiding in utilities or just buying anything with a dividend. But here's the gap. The energy sector, ETF, energy, up only 2% this week with crude at 89 and the Strait effectively closed. If traders think this is a repeat of April 8th, they're fading the war premium in energy equities. If crude holds above 88 at cash open and the energy sector, ETF, doesn't catch a bid by 10 a.m., that tells me the market is choosing quality over cyclical exposure, even within the energy space.
And that fits the macro picture. If inflation is sticky from supply shocks and geopolitics, cyclical sectors with volatile earnings get discounted. Staples and healthcare get a premium because they can pass through costs. The rotation is telling us that the market is slowly pricing in a longer-lasting inflation environment, not a transitory spike.
My gut book is already positioned for that reality. The energy sector, ETF is my play, but I need the crude to hold.
Shifting to international overnight flows. Asia was mixed but mostly calm. The Nikkei 225 in Japan eked out a gain of 0.06%. The Hang Seng in Hong Kong slipped 0.65%, while Shanghai added 0.7%. Korea's Kospi was up 0.43%. In Europe, the DAX in Germany is flat, the FTSE in the UK up 0.5%, and the Euro Stoxx 50 up 0.69%. The macro plumbing, dollar-yen, is basically unchanged, hovering near the levels it's been at, so the yen carry trade isn't unwinding aggressively yet. But the Bank of Japan rate decision next week is the real risk. If they tighten or even hint at reducing accommodation, the carry trade unwinds quickly, and that hits U.S. tech names that are funded by yen borrowing. For today, the international flows don't point to a major risk-off beyond what the crude move is telling us.
In China's data dump next Tuesday, retail sales, unemployment, could shift the global demand narrative for commodities. But that's not today's problem. The story right now is oil and the Strait, and whether that 88 handle on West Texas Intermediate crude cracks.
Portfolio Hot News segment. The theme that's touching our books most directly is the HBM memory chip inflation and what it means for the tech trade complex. We touched on it earlier, but let's go full depth. The driver is clear. Artificial intelligence accelerators from NVIDIA and AMD require stacks of HBM memory, and the latest HBM3E generation is seeing a 40% quarter-over-quarter price increase. Supply is bottlenecked. Samsung and SK Hynix are running fabs at maximum, but yields are stubbornly low, while Micron is ramping its HBM3E production. This is not a short-term blip. It's a structural supply-demand imbalance that could persist through 2027. The first-order effect is margin compression for any company building artificial intelligence infrastructure. The hyperscalers, the cloud providers, and, by extension, the software names that rely on them. The second-order effect is that consumers pay more for laptops, phones, and any device with advanced memory, which reinforces the sticky inflation narrative.
So the bull case for Micron, ticker MU, is that they have pricing power they haven't had in a decade. If HBM demand outstrips supply, Micron beats earnings and guides up, and the stock could run even if the broader market is choppy. The bear case is that the whole semis complex trades as a group, and if HBM costs ripple through PPI and force the Fed to stay tighter, rates hurt high. Multiple tech regardless. My TFT algo holds semis, so I'm caught in that crossfire. The system is long, the very names. That could win on pricing power, but lose on valuation compression.
And my paper account is watching Micron closely, but the Wave Trader Algo's risk framework won't let me enter anything new until VIX settles below 4.0, which feels miles away right now. I'm not stepping in front of this volatility train. The HBM story is a multi-year structural shift, not a two-day trade, so patience is the right call.
Patience is everything. I'm not buying today. My gut book has the energy sector, ETF, which is working, but my paper tech positions are getting drilled, and I'm not doubling down. The 88 handle on West Texas Intermediate crude is my line in the sand. If crude holds, great. If it fades, I stop out and live to fight tomorrow. No new money until the market tells me where it's going.
Same here. I'm not buying today. Cash is there, but nothing is screaming. Adobe tonight will inform the software picture, PPI. Tomorrow will confirm or break the bond market's move, and the ECB could stir currency volatility. Plenty of catalysts on the horizon without chasing.
Here's what we're watching tomorrow. Concrete levels and events. First, West Texas Intermediate crude at $88. If it holds above that through the close, the energy sector. ETF gap starts to close, and my energy bet gets conviction. If it breaks below 88, the April ceasefire template wins. Second, core PP. I consensus at 5.4%. A print above that number validates the sticky inflation fear and keeps the 10-year bid. A print below that triggers a relief rally in tech. Third, the ECB at 2.4%, and Lagarde's tone. Any hint of more hikes coming pushes the dollar higher and risks further pressure on emerging markets and commodities. Fourth, Adobe's earnings after the bell tonight. If they miss on margins due to cloud costs, the HBM squeeze is real, and software names take another leg down ahead of the Friday open.
Clean watching list. We'll know by tomorrow's close whether yesterday's panic was the right move or a major overreaction.
Until then, protect your capital, respect the fire, and remember, the tape doesn't care about your thesis. We'll see you all tomorrow, bright and early. This is Wildcard, signing off with a full tank and a steady hand.